So just so you can see the 4 hour in use on all different asset classes, I want to take a look at this on Aussie 200. So we've got this 4 hour entry here. This is an entry that I think that you shouldn't take for number one reason. If you take a look at the overall range, you've got from high to low, look how far we're moving into almost 70% and more of the structure itself. And when you zoom in, it's becoming closer at the time to an M style structure. So if I just take this back so you can see around here, look at how far we're in. This is where you can still utilize everything you know. If you are ever unsure what have you got in your locker, I'm going to wait for an insurance entry to avoid unnecessary losses. So when we get this far, you can have a little bit of tolerance with the 4 hour in the sense of your typical example of if you've got an impulse and you're looking for a continuation, you ideally don't want that bigger than 50% of the run, right? If it's 55, closer to 60, but you've got the 4 hour rejection, you've got a little bit more on your side because you've got a more heavy weighted time frame. But when you're dealing with something, you start getting into the 70, 75, it's getting closer towards the highs. Just stick to the insurance entry. So this would be a good example of a trade that I wouldn't take, that you've got right gap, you've got the consolidation there, the rejection, you would take it like this to have your stop above the high. Let's put it exact. So let's say you've got your entry just below there. You've got your target down there. It meets the criteria in terms of the 3 to 1, yes. But let's go. Right, so this technically hits target. This is the trade where some of you by spread, you might have been tagged in and then maybe tagged out. It was one of those ones that you might have been tagged into it, you might have avoided that, and then you just would have got tagged in with the momentum coming in. Even though this could potentially be a winning trade at 3 to 1 target, I would prefer you to avoid those trades because of those components. The beautiful thing is there are so many high quality 4 hour trades, you don't even need to worry about these trades. And it leads me on to the next point. I want you to focus more on continuations. Forget about reversals. Just like I say in the base plan, focus on continuations. Reversals, they can come at a later stage, and even if then, you don't even need it. When you see this continuation that plays out that I said that you shouldn't take, you've then got one step further. You've got this trade right here, which is the break of this high. We sell off, we're at these lows, we reject here. What do we create? A hook point, price comes back up, and you've got the entry criteria. Technically, this one, the entry criteria is correct. But would you take this trade like so, with your stop above the high, call it 35, and to the low 1.7? No, because you can't get the 3 to 1. You might be saying, well, I can still manage it, but we're still unconfirmed. If I zoom out and you start to see, look at this, there's a big difference between something that is in a trend versus something that is part of all of this squeeze. You want to see breaks below here and then you start entering. Was there a way to enter this trade at an advanced level? Yes, but that is in AFT. Right, so there was a better way that you could have got 3.5 to 1, and if it was situational that you was in profit, you could take it. That's absolutely fine. The easiest way to wonder, because you might be saying there's going to be scenarios where let's say that was a 2 to 1 and you can manage it and you could justify it. The simple question that you want to ask yourself is, if you're at minus 3%, are you comfortable this trade being a loss and you're at minus 4? Versus you're running at 5%, are you comfortable being from 5% to 4% profit to find out whether this is going to be an 8% trade or break those lows? Very, very different thought process, which is why you always have to assess, can I afford to take the risk? Because if you're looking at the size of this and saying, well, what about the sequence because of the position on Aussie dollar? It's very different when you're in a squeeze versus, let's say we zoom out and we see this is the high, this is the low of this whole entire range, if you like. Let's say you've got this as a correction, it drops, and then you've got, again, a correction here. What's the difference? This one is in a trend. This one is way over 50% and still part of all of this. So yes, sequence is going to be slightly less important when you're dealing with a 4 hour structure because it's just a heavier weighted structure and you have a 4 hour rejection. But remember, you want to be taking things that are within the trend like this versus taking something here. Just because it's got a 4 hour rejection doesn't mean it negates everything else you know, which is to wait for an insurance entry. So this is a trade, technically could be a loss, could be a winner, but one I would avoid taking for those variables. So I want to focus on another loss here that you should avoid. Look at the candle shape. So this is the doji. It's less effective. You can find loads of examples of this candle shape in this type of area for this situation. I want you to avoid. So if I zoom in and you see that rejection, you're going to think, or some of you you'll try to get too smart with it, and you'll think, well, do you know what? I know there's a doji that I should avoid, because traders have a tendency to disobey their rules. They'll look at it and they'll think, well, I can enter here, so I don't have to be below this low. I can stop crop it, therefore I can get a 35 pip stop, and then therefore it still meets the criteria for over a 3-to-1. Versus if you had it like this in the conventional sense, even if you stop cropped it through there, you'd still be 2.2. If you had it above, it's a 1.8. It's not even a 2-to-1. You should avoid it, but you shouldn't avoid it for risk to reward. You should avoid it because of the doji itself. Just because it's a weighted time frame doesn't mean you should take it because there's rejection. So I want you to avoid that. That's why I mentioned in the diagrams, you really want to move away from those type of entries. So if you look at it in hindsight, look at that. There's parts of that could catch you off guard, because you look left and think there's a lot of momentum there. As long as my stop's above, what's the issue? It's not about the wick fill. It's the fact that this is in a very indecisive candle on the 4 hour. And on top of that, if you measure it, this is closer to 60, nearly getting into the 70% territory, where you could see it as an M-style structure. And then long and behold, you'd be tagged in, tagged out, unnecessary loss. You don't need to be dealing with that. So just remember this candle shape. I want you to look at lots of examples, and you're going to find them when you test. These are the type of ones that you want to avoid. This is barely an entry here, but even this would be better. As you can see, this particular structure is more of your steeper continuation. What do you at least have here? You have an impulse, a correction, you have this continuation, and then you have your entry right here. So if you look at this position, we'll grab the short tool, and you look at 48 pip stop, technically that could be close to meeting the criteria, but why wouldn't you take that? You wouldn't take it because of where it is within the range. It's much steeper. This is much more intricate. If anything, you would go into lower time frames here, and there'll be an entry within here that's way more precise, and you'd be able to get something like this that suddenly meets more of the criteria to manage it, etc., etc. But this is your steeper one. They're not the worst trades in the world, but if you compare it, this is already a much better trade than that, just to show you a comparison of how important it is to not take that trade. There are so many extra losses in there that I want you avoiding, and the beauty is we have a very strict, clear criteria of better quality trades. So avoid these long-legged dojis. They're not good. So now you know what not to look for. Let's take a look at what meets the criteria. We've got the JP225. We've got this A to B leg playing this range. We have our rejection wick all the way through the highs. We're looking for this run to the downside. So if we now go to the lower time frames, we go to the daily, we start to see the initiation of the run. We then go into the 4 hour time frame. We've got our 4 hour flat structure. Now you might look at that and say, well, it's above this high. Yes, but you've got to look at the deliberacy of, is this a deliberate run or not? If you've got a phase 1, phase 2, do you think this is going to be a tag you in and that? That's not really a structure that you would see. If anything, you're looking at this as a break of the high, the break back in, and this is the clue that we're going to break back to the downside. And also, you can manage it from the high to the low anyway. So that meets all of the criteria. But before we go into the 4 hour, which is in here, the entry, the retracement, I want you to first remember what I mentioned. Just because we got the 4 hour, it does not mean that now the only entries that you look at are 4 hour entries and you ignore 1 hour entries. The 4 hour can be that criteria as an insurance to a lack of a 1 hour entry. So if we go to the 1 hour time frame and we look at this structure, this actually gives you your 1 hour entry. So we have our 1, our 2, our 3, our continuation. You've got this high above. You wouldn't be worried about that because that's way too far away. And then you've got this as your base. Let's draw it in. So you have your base here. So let's say you're seeing this as a continuation. Your thought process is going to be, can I manage it from here to here? Because that's really what's important in your mind. Now you might look at the first rejection. So if we replay that back, you might look at this rejection and say, right, we've scooted back up, we've filled this wick, we have our first rejection. Even if you were to set your order, even if you were to set your entry like this, with your stop above and your target around here, you will see, right, you're not tagged in and you're tagged in here. So that could initially look like a loss, and even if it was, you would get another opportunity to get back in. But this would be an example in which that you've set your entry and you technically haven't been taken in, and you actually get the benefit and the advantage of not knowing where that wick was, because you would have just positioned it above here. So you would have had a tighter stop, and your target, even if you had that as a target as a 7-to-1, it still would have worked. But what I'm referring to here more so is that you may have waited, here is your 1 hour rejection. How would you have taken that? You would have got in like so with your stop above the high, or cropped through the wick. Now this is where cropping through the wick, you could say that does fall into the category of someone who knows a little bit more, but I wouldn't say it's a super advanced technique. It's more about, once you've got a bit of experience, you will understand when price has washed orders out. So think about that from an area of liquidity. If that's taken out all of the liquidity and you've got a heavy body candle rejection, that's the type of candle shape that usually has a follow through. So do you technically need to now protect it all the way above the highs, or does it just need to be above the recent wicks, or 50% of the candle? So what you can do is simply measure 50% of the candle like so, and then see, right, as long as my stop is here, which happens to be just in line with those highs anyway, you can have your stop like that. So that helps you from a stop positioning, keeps it super mechanical, straightforward. Does that meet the criteria of 3-to-1? Yes, it's over that, it's 4-to-1, and then to the low it's 4.3. So that meets all the criteria. I'm mentioning this because I don't want every single time when you see a larger structure, you ignore really high quality trades just to wait for the 4 hour. The 4 hour is not always going to be the answer. I still want you to layer your trades. I still want you to look at it in sequence and see, right, this low right here has broken. We've come back up, we've tested it once, two, so we've retested all of this area and we've washed all of that out. What's the chances that's going to be a high quality trade? Very, very high. So that's still your trade there. If we go to the 4 hour time frame, this is where the extra entry, let's say it wasn't in your time zone, you couldn't get it, you wake up and you see, right, 4 hour retrace. Then you look at that 1 hour thinking, oh, I should have got involved in that trade, but I couldn't. It is what it is. Does this still make sense to you? Yes, because you've got the complete retracement. So you've got your bullish pressure here and you've got your complete retrace. Your retrace would then be you're entering like so. You can either enter below the wick or you can enter right here, because you're not dealing with a long-legged doji, so you can get a slightly tighter stop. You would already have gone to that lower time frame to check, because you're not just going to stay on the 4 hour. Naturally, you would go to the 1 hour, see where it is, and think, right, if I'm on the 4 hour time frame, if I would have got in here, I wouldn't have had my stop there. So you still get to position your stop in the same way. You are dealing with a wider stop, but it's all relative because you're trading with this type of instrument. So what have you got here? Can you manage it? You might be saying, well, do I want to get involved in that trade? Well, there's a difference. You're not trading in something that is in a big squeeze. What you're trading from is the potential for this run. So it's a completely different thought process versus managing something that is a correction into a correction. This is very direct. Phase 1, phase 2, phase 3. So my question in this scenario would be, would I be comfortable going from -1 to -2 with the potential for this to be the run? 100%. Would I be comfortable at +1 and going back to break even to find out whether this is going to be the trade? Yes, because what have I got? Direct momentum, 4 hour continuation, 1, 2, 3, complete 4 hour retrace, followed by the previous trade that is already in that run of momentum that I would have missed on the 1 hour. Can I afford to get to roughly 1.7? I'm saying this is being generous with the stop. You might even get tighter. Can I afford to get involved in this entry and manage it at 2%? Yes, that would be a trade I can afford to take the risk. So then we play the trade, and you can see we're playing this A to B leg, even if you're just trailing your stops. Because remember, with the 4 hour management, 3-to-1 is your minimum. Now there are going to be scenarios in which that you're managing a little bit looser if you're taking more of a 4 hour swing style position, if you like. You're able to trail that every 4 hours. Now I'm going to get to the management part at a later stage, but you're going to start to understand how you can trail that. I would say even in a worst case scenario, you would have got out for about 7.5%. Best case scenario, you would trailed it loosely. I mean, they're not always going to be these big hitters, but imagine this on your personal account. Imagine the build that you could do on that, or if you're trading someone's investment account, right, and you got private investment, it's an absolute game changer for these runs. So that is the simplicity of the trade. But can you see how you've just added an extra entry? What's the chances that you're actually reducing FOMO now? Probably quite high, right? Why? You're reducing FOMO because even if you didn't get that entry, you're not sitting there thinking, right, didn't get my perfect entry, and you walk away and then you get down in the dumps. Like, no, you know that now you've essentially been gifted another possible way to get a very safe entry. Was there a more advanced way to get in? Yes, there was an AFT entry, which is, this is more 4-hour mastery, but I won't get into that here. But to just roughly put on what that would have looked like, you would have been dealing with, I mean, again, if you would have got out a similar area, you're talking 13.7, big difference. And best case scenario, I mean, it's not very often that you're going to be hitting a 30% trade, but it just goes to show if you're in the right run, if you're positioned well, you know what you're doing, and you can refine these entries, even with a higher time frame. Absolute game changer. So that in a nutshell, there's so many lessons within here, but I wanted to cover that so you don't get stuck on the 4-hour thinking that's the only way to enter. No, the 4-hour can be your insurance to a trade you're not sure about, and also it can be an extra entry because maybe it's just not in your time zone, which gives you extra prep work. It makes your prep work even easier. Right, now let's take a look at another winning position. So we have pound Swiss here. What I love about this entry on the 4-hour is that it would be, again, easy to talk yourself out of the trade. Why? Because of this gap. Now, this is not your near miss. This is a huge gap in price. So you might talk yourself out of the position. But remember, we're dealing with the 4-hour. So you've got to look at things in layers. You've got to look at the weight of the move itself. What do we have here? We've got phase 1, phase 2, phase 3. Is there a reason for price to come to the downside? That's what you've got to look at it in terms of its range. Now, remember, every gap doesn't need to fill the 24 hours or 48 hours after. It could take weeks, sometimes months. So you've got to look at the weight of the time frame. Now, there could be one other area that you would look at. You might have this in, because sequence-wise, momentum, continuation, it's all there. You might have this in thinking, well, what about this being filled? Can I take that time frame? Your 4-hour is already mitigating risk. That's the crucial part about this. So when you start getting into the lower time frames of that, and you see, right, gap, all of that, again, this is the doji you'd want to avoid anyway, another doji you'd want to avoid, then you get your first rejection, which is actually a decent rejection, because when you think about it, you've essentially had your indecisive candle on a 4-hour, then you've had one more 4-hour candle, which is more of a heavy body, it just finishes bullish, but it does wick through all of that, so you had the double wick. So you've got to ask yourself the question, what is the chances that we then move to the upside? So your first actual entry does become here, like so. So your first entry becomes like this. Is this the best entry? I don't believe so. But that technically is your first entry. And you would be looking at, can I manage the trade? Yes, I can get away with management because I'm looking for a longer term run. And then you're looking for this to this low here. Now, I know many people would have caught a position like this, even on a lower time frame to that, but you can see how the 4-hour still plays its role. The key entry that I want to refer to is actually the second one, because I could understand with some of you might be unsure on that. What would mitigate the risk of the idea of, I'm not going to take this trade because I'm worried about price filling both of those wicks and hitting that area, so I'll just take an insurance entry, the next 4-hour candle. So you get your follow through. So any concerns you had has now already been dealt with, because you've had your complete retrace of that, and you've actually had a follow through of the heavy body bullish candle. So technically, let's replay this back. Your entry is there. So even after this candle close, and then you've got potential swap hours, you know, you'd wait for that to calm down. You'd have your entry like so, and you'd have your stop either slightly cropped, or let's say on the more conservative side, you had this as a 30 pip stop. Can you manage it? Yes, 1.3. It's not a massive area, but you're not trading 50% into the range. You're trading it with the idea that, right, this is a phase 1, phase 2. You got to remember, because you might be wondering, okay, so in certain scenarios, if it's only 1 or 2%, I want to leave it alone. In this scenario, I would trade it. The reason why you would is that, look at the difference. This is a clear momentum play. You've got your left, your right, you've got a full continuation and a 4-hour follow through. So the probability of this stopping here is very, very low. So in my thought process here, it's going to be, can I manage it to that low? Because that's what's important at this stage, to find out whether this is going to break that low and be this trade. You best believe that's the case. Where if this was a breakout and then all the way down here was a 4-to-1 and it had to travel all that way, would that be worth it? Maybe not. So this is why you have to understand that trading is situational. So in this scenario, let's play that out. Should roughly be running at this stage at peak, you would have got 6.8. And even down here, if you've been trailing your stop, you would have walked away with about 5% on a very simple trade. What's the benefit of this? It's because it shows you and demonstrates the extra entry. It shows and demonstrates the flexibility, your ability to prepare. Imagine you're at work and that you don't want to be on the intraday timeframes and you can't even check your phone, and you was able to go, right, just need to wait for that 4-hour close. Yep, that's there. Let me set my order, set my entry above, let it do its thing, and then I manage it more loosely. As soon as it gets to low, move it to break even. As we start to break the structure, we can start to slowly lock in profit. You can let that be almost a background position running, knowing that you don't need to get the perfect time frame. I've lost count the amount of times that I've been in trades or looked for an entry on the lower time frame where the higher time frame structure commits. So call this a higher time frame, phase 1, phase 2, phase 3. You see it play out. You looked for a lower time frame entry. It just never came, or if it did come, it wasn't in your time zone. So you see the whole move play out, but you don't benefit from none of that. The 4-hour is going to help mitigate against all of that. Now, there was another way to get into this, which is more of an AFT entry, and that's the beauty of this. I'm telling you, once you master this in a simple 4-hour play, you're able to have the 4-hour mastery. You're going to get tighter stops. As an example, you'd be looking at more of getting in roughly around this area. Tightest stop would have been cropped about 15, which changes that down into more of the 11%, and at the peak of that 13.6. So it's the same thing, just more refined once you know what you're doing. Now imagine that on your personal account. How much would that be worth to you? Just a simple 4-hour play. Imagine you've got your 6-figure personal account, which is what you should be aiming towards. That's easily a 10 to 15k position just in one move. So the power of that is really not skipping levels and understanding what is a good entry, what's a bad entry. This one meets all of the criteria. Even though the gap is there, it still has more than enough confluence for this to follow through.